Liam puts his retirement money into a 401k. Noah puts his retirement money into a Roth IRA. They both invest for more than 30 years. They both retire at the same age. And when they check their accounts, Liam looks richer. But when they start spending the money, Noah may actually keep more. Because the number on your retirement statement is not always the number you own. And once you include taxes, employer matches, penalties, Social Security, and required withdrawals, the account that looks like the winner can quietly become the trap. Before we run the numbers, hit subscribe and like this video if you want finance explained without hype, without confusion, and without someone selling you a fantasy. This is educational, not financial advice, but by the end, you'll understand the real math most people never calculate.
Let's keep this fair. Liam and Noah are both 30 years old. They both earn $75,000 a year. They both live in the same city. They both want the same thing: retire comfortably, avoid money stress, and never wake up at 62 wondering where 3 decades of paychecks went. The only difference is the account they choose. Liam uses his company 401k. His employer offers a 4% match. That means if Liam contributes 4% of his salary, the company adds another 4%. On a $75,000 salary, that match is $3,000 a year. Free money, not maybe money, not if the market performs money. Money his employer puts into his retirement account simply because Liam participated. Liam decides to contribute 10% of his salary. That is $7,500 a year. With the employer match, $10,500 goes into his 401k every year, and because it is traditional pre-tax money, Liam does not pay income tax on that $7,500 today. His paycheck still goes down, but not as much as it would if that money had been taxed first. Noah chooses a Roth IRA. He contributes $7,500 a year, no employer match, no tax deduction today, no immediate reward. Every dollar Noah puts into the Roth has already been taxed. So from day one, Noah feels the pain more than Liam does. Liam gets a smaller tax bill today. Noah gets a smaller paycheck today. Liam gets a company match. Noah gets silence. Liam logs into his account and sees the balance grow faster. Noah logs into his account and sees something smaller. And for the first few years, it is not even close. Liam looks like the genius. By the end of year 1, Liam has roughly $11,200 in his 401k, assuming a 7% return. Noah is around $8,000 in his Roth IRA. By year 3, Liam is around $36,000. Noah is around $26,000. By year 5, Liam has crossed roughly $64,000. Noah is closer to $46,000. That is a real gap, and Liam knows it. At work, when someone says, "I finally started investing," Liam says, "Make sure you use the 401k. The match is free money." And he's right. The employer match is one of the most powerful tools in personal finance. If your employer gives you a match and you ignore it, you are walking past money that already belongs to you. But here's where people make the mistake. They see the 401k balance, they see the tax deduction, they see the match, and they stop thinking. They treat the full 401k number like it's theirs, but it's not. Part of Liam's 401k belongs to future Liam. Part of it belongs to the IRS. He just doesn't know how much yet. That's the hidden problem with pre-tax retirement money. The government didn't forgive the tax, they delayed the tax. And delayed bills have a dangerous psychological effect. They make you feel richer than you are. When Liam contributes to his 401k, he avoids taxes today. That feels amazing. At a 22% marginal tax rate, his $7,500 contribution may save him roughly $1,650 in federal taxes that year. That's not theory, that's real money he keeps right now. He can use it to pay bills, invest it, build an emergency fund, or, like most people, accidentally spend it without noticing. But whether Liam uses that tax savings wisely or not, the 401k has created a deal. Liam gets relief today, the government gets paid later, and later can be dangerous. Because every dollar Liam withdraws from his traditional 401k in retirement is taxed as ordinary income, not long-term capital gains, not some special retirement discount. Ordinary income, like a paycheck. When Liam withdraws $60,000 a year in retirement, the tax system treats that money as income. He may not be going to work anymore, but the IRS still sees income. And that means Liam's retirement account is not just an investment account, it's also a future tax account. Noah's Roth IRA works the opposite way. Noah gets no deduction today. He pays taxes before the money ever goes into the account. That hurts. But once the money is inside the Roth, qualified withdrawals and retirement can be tax-free. The contribution was taxed, the growth can be tax-free, the withdrawal can be tax-free. That's why Roth IRAs feel boring in your 30s, but powerful in your 60s. The reward is delayed, and most people are terrible at valuing delayed rewards. For the first 10 years, Liam's account keeps looking better. After 10 years, Liam has roughly $155,000 in his 401k. Noah has around $111,000 in his Roth IRA. On paper, Liam is ahead by $44,000. That looks huge, but now ask the better question. How much of Liam's $155,000 is actually his? If Liam eventually pays 22% tax on that money, then around $34,000 of that account is not really his, it's a future tax bill. His after-tax value is closer to $121,000. Noah's $111,000 isn't bigger on paper, but qualified Roth money doesn't carry the same future tax bill.
So the real gap is not $44,000. It is closer to $10,000, and most of that difference came from Liam's employer match. Now go to year 20. Liam's 401k is around $461,000. Noah's Roth IRA is around $329,000. On paper, Liam is winning by $132,000. That looks huge. But if Liam had to pay 22% tax on that balance, his after-tax value is closer to $360,000. Noah's Roth value is still around $329,000. Now the real gap is only about $31,000. Still a lead for Liam, but nowhere near what the statement made it look like. This is the part that breaks people's brains. The 401k can look bigger every single year, while the Roth quietly becomes more powerful every single year. Because the 401k number is gross, the Roth number is closer to net. One is before the government takes its cut. The other is after the government already took its cut. That difference matters more with time. Now let's fast forward. Liam and Noah both retire at 62. They invested consistently for 32 years. They both earned the same return. They both stayed disciplined. Liam's 401k has grown to about $1.24 million. That is a 7-figure retirement account. It feels incredible. He tells his friends, "I'm a 401k millionaire." And technically he is, but not all of that million belongs to him. Noah's Roth IRA has grown to about $885,000. No 7-figure screenshot, no dramatic milestone, no bragging rights at the retirement party. But Noah's number is cleaner. He already paid the tax. Now both men start withdrawing $60,000 a year. Liam withdraws $60,000 from his traditional 401k. That withdrawal counts his taxable income. After deductions, his federal tax bill could be around several $1,000s a year, let's say roughly $5,000. So Liam withdraws $60,000, but he may only keep around $55,000 after federal taxes. And if he lives in a state with income tax, the gap gets worse. Noah withdraws $60,000 from his Roth IRA. If the withdrawal is qualified, his federal tax bill is zero. He keeps the full $60,000. Same lifestyle target, same withdrawal amount, different outcome. Liam needs to pull more money out to spend the same amount. Noah has more control. That control becomes even more important when Social Security enters the picture.
Imagine both of them collect $24,000 a year from Social Security. Liam's 401k withdrawals count as income when determining how much of his Social Security may become taxable. The higher Liam's combined income, the more likely part of his Social Security gets taxed. In some cases, up to 85% of benefits can be taxable. That does not mean he loses 85%. It means up to 85% of the benefit can be included in taxable income. Still, it's a real tax drag. Noah's Roth IRA withdrawals generally don't count the same way. That means Noah may be able to keep more of his Social Security from becoming taxable. This is why Roth money isn't just about avoiding taxes on investments. It's about controlling your tax picture in retirement. Control over taxable income, control over Social Security taxation, control over Medicare premium thresholds, control over when and how money comes out, and control is one of the underrated assets in retirement. Now let's add another rule: required minimum distributions. At a certain age, the government eventually says, you have delayed taxes long enough. For many retirees, traditional retirement accounts require withdrawals starting at age 73. That means Liam can't just leave his traditional 401k untouched forever. If the account is large, the required withdrawals can become large, and if Liam doesn't need that money, too bad, he still may have to withdraw it, and he still may owe tax on it. That forced income can push him into a higher tax bracket, make more Social Security taxable, and reduce his ability to control his retirement tax plan. Noah's Roth IRA doesn't have lifetime RMDs for the original owner. He can leave that money growing as long as he lives. If he doesn't need it at 73, he doesn't touch it. If he lives to 85, it can keep compounding. If he wants to leave it to his children, it can be one of the cleanest assets in his estate. That doesn't mean the Roth always wins. It means the Roth gives a kind of flexibility the traditional 401k does not, and flexibility is worth money. Now, pause for a second. If this is helping you see retirement accounts differently, subscribe and like the video. Most people pick accounts based on what their coworker said, what TikTok said, or what their HR portal made easiest. But the account you choose can change how much money you actually keep later.
Now, let's talk about emergencies, because life does not care about your spreadsheet. At age 50, Liam and Noah both face a problem. Maybe it is a medical bill, maybe a family emergency, maybe a once-in-a-lifetime opportunity. They both need $30,000. Liam looks at his 401k. The money is there, but Liam is under 59 and a half. If he takes an early distribution and no exception applies, he may owe regular income tax plus a 10% penalty. A $30,000 withdrawal could cost him thousands in taxes and penalties. He might pull out $30,000 and only keep around $20,000 after the damage. He needed $30,000, but his retirement account did not behave like $30,000. It behaved like locked money. Noah looks at his Roth IRA. Here is the feature many people do not understand. Roth IRA contributions can generally be withdrawn at any time, tax-free and penalty-free. Not the earnings, the contributions. If Noah has contributed $7,500 a year for 20 years, he has put in $150,000 of contributions. He can pull $30,000 of contributions without tax and without penalty. Same emergency, same dollar amount, completely different experience. Liam's account is bigger, Noah's account is more flexible. And sometimes flexibility is the difference between surviving an emergency and creating a second emergency. But we still cannot pretend the Roth is perfect. The Roth IRA has serious limits. First, the contribution limit is small. In 2026, someone under 50 can contribute $7,500 to an IRA. That is helpful, but it is not enough for many people who want to build serious retirement wealth. The 401k employee contribution limit is much higher. For 2026, it is $24,500 if you're under 50. That means the 401k allows more than 3 times the contribution room of a Roth IRA. If you're a high saver, the 401k gives you room the Roth IRA simply does not. Second, the Roth IRA has income limits.
If Noah's career takes off and he starts earning too much, his ability to contribute directly to a Roth IRA can phase out. There are backdoor strategies, but they add complexity, and complexity is where many people give up. Third, the Roth forces you to pay taxes now. That can be expensive. Remember Liam's 401k contributions saved him roughly $1,650 in federal taxes each year at a 22% marginal rate? Noah does not get that. Over 32 years, Noah may pay more than $50,000 in taxes up front that Liam delayed. And if Liam invested his tax savings every year into a brokerage account, that side account could grow close to $195,000 at a 7% return. That is not a small detail. That's real money. This is where most Roth fans oversimplify the debate. They say tax-free growth is better, but tax-free growth is not free. You paid for it up front. The question is whether the upfront tax price was worth the future tax freedom. If you're young and in a low tax bracket, it often is. If you're in your highest earning years and paying a high tax rate today, it may not be. That's the real math, not 401k good, not Roth good. The question is, when is your tax rate lower, now or later? If your tax rate is higher today and lower in retirement, the traditional 401k can win. You deduct income at a high tax rate, then withdraw later at a lower tax rate. That spread is profit. If your tax rate is lower today and higher later, the Roth can win. You pay tax when it's cheap, then avoid tax when it's expensive. That spread is also profit. So, the real winner depends on your life, your salary, your tax bracket, your employer match, your state taxes, your retirement age, your spending needs, your Social Security, your discipline, and your ability to invest the tax savings instead of spending them. Because here's the uncomfortable truth. The traditional 401k only reaches its full power if you do something smart with the tax savings. If Liam saves $1,650 in taxes but spends it on random purchases, the 401k advantage shrinks. If he invests that savings every year, the 401k becomes much more powerful. That's why two people can use the same account and get very different outcomes. The account is not magic, behavior is the multiplier. Now let's answer the question people actually care about. What should most people do? For most workers, the best strategy is not 401k versus Roth IRA, it's both.
Step 1. Contribute to your 401k up to the full employer match. If your employer matches 4%, contribute at least 4%. That match is a guaranteed return on day one. No Roth IRA can replace free employer money. No index fund, no stock tip, no crypto hype, nothing. If you skip the match, you are leaving part of your compensation behind. Step 2. After you capture the full match, consider maxing out a Roth IRA if you are eligible. That gives you tax-free retirement money, flexibility, and a bucket of cash that may not increase your taxable income in retirement. Step 3. If you still have money left to invest, go back to the 401k and increase your contributions. That gives you higher contribution limits, more tax sheltering, and more automated discipline. This order captures the best feature of each account. The 401k gives you the match. The Roth gives you tax-free flexibility. The 401k gives you more contribution room. Match first, Roth second, more 401k third. That is not the only strategy, but for many people, it is the cleanest starting point. Now, when does Liam's 401k strategy clearly win? It wins when the employer match is strong. It wins when Liam is in a high tax bracket today. It wins when he expects lower taxable income in retirement. It wins when he needs to shelter a lot more than $7,500 a year. It wins when he needs automation, because money that never hits his checking account never gets spent. And it wins when he actually invests the tax savings. When does Noah's Roth IRA strategy clearly win? It wins when Noah's young and in a low tax bracket. It wins when he expects higher taxes later. It wins when he wants tax-free withdrawals in retirement. It wins when he wants flexibility before 59.5. It wins when he wants to avoid lifetime RMDs. It wins when he wants more control over Social Security taxation and retirement income.
and it wins when future tax rates rise. Nobody knows exactly what tax rates will be 30 years from now, but if you believe tax rates could be higher in the future, Roth money becomes more valuable. If you believe your own income will rise dramatically over your career, Roth money also becomes more attractive early. That is why the Roth is especially powerful for people in their 20s and 30s who are not earning their peak income yet. Pay the tax while your tax rate is low, let the growth happen tax-free, then use that money later when taxes could be higher and your life is more expensive. But if you're 45, earning a strong income in a high bracket with a great employer match and you expect to spend less in retirement, ignoring the 401k would be a mistake. The best account is not the one with the best slogan, it is the one that fits your math. Liam thought the 401k was the obvious winner. Bigger balance, tax deduction, employer match, higher limits, and he was not wrong. Noah thought the Roth IRA was the smarter long game. Tax-free growth, no lifetime RMDs, flexible contributions, cleaner retirement income, and he was not wrong either. The mistake was thinking one account always beats the other, because the real winner is not 401k or Roth IRA. The real winner is the person who uses both strategically. The person who gets the match, builds tax-free money, uses the higher contribution room, keeps some flexibility, and enters retirement with multiple tax buckets. That's the part most people miss. Retirement is not just about having money, it's about having choices. If all your money is in a traditional 401k, every withdrawal may create taxable income. If all your money is in a Roth IRA, you may have given up valuable deductions during high-earning years. If all your money is in a regular brokerage account, you may have missed decades of tax advantages. But if you have a traditional bucket, a Roth bucket, and maybe a taxable brokerage bucket, you can control your retirement like a dashboard. Need income but want to stay in a lower bracket? Use Roth money. Need to fill a low tax bracket on purpose? Use traditional withdrawals. Need flexibility before retirement? Use taxable brokerage or Roth contributions. That's real financial planning, not chasing the highest balance, not copying your coworker, not following a 30-second clip, actually building options.
So the next time someone tells you the 401k always wins, ask them, did you include the taxes on the way out? And the next time someone tells you the Roth IRA always wins, ask them, did you include the employer match and the tax deduction on the way in? Because both sides love to leave out the part that weakens their argument. The 401k crowd forgets the government still owns a piece. The Roth crowd forgets paying taxes up front has a real cost. The truth is in the full equation, not the headline, not the account balance, not the emotional feeling of tax-free. The full equation. Before you make your next contribution, ask yourself 4 questions. Do I get an employer match? What tax bracket am I in today? What tax bracket might I be in retirement? And do I need flexibility before age 59.5? Those 4 questions will put you ahead of most savers, because most people never get past the first question. They just choose the default option and hope it works. Hope is not a retirement plan. Math is. If this video helped you understand the real difference between a 401k and a Roth IRA, hit the like button, subscribe to the channel, and comment below. Team 401k, Team Roth, or Team Both. And remember, the account that makes you look richer is not always the account that makes you keep more. The answer that includes everything is the only answer that matters.